Hey traders, and welcome back to a new episode of TLA. Ever wondered what sets professional traders apart from the newbies? It all comes down to mastering how to read and interpret the market's language. And that's exactly what we'll be diving into in this advanced session today. Today, we're taking a deep dive into one of the core concepts in trading, liquidity. We'll also break down the mindset of smart money and expose the strategies big financial players use to influence the market, mislead traders, and create deceptive setups. Moreover, we'll reveal actionable liquidity patterns that commonly appear in the market, patterns that every trader needs to recognize to maintain an edge in the market. So be sure to watch this video carefully all the way through, and have your notepad ready. We're about to arm you with some game-changing insights. So traders, if that sounds like your thing, hit the like button to show some love, and don't forget to subscribe if you're new here. See you right after the intro. Welcome back, traders. Let's jump right in. Before we get into the common liquidity patterns and scenarios that form regularly in the market, we need to start with a clear breakdown of smart money and liquidity, and what these terms actually mean. Picture this: major financial entities, often labeled as smart money, are looking to buy into a currency pair. To accomplish that, they must have a large pool of sellers and a matching volume of sell orders in the market. This is key, because without enough sellers available, no trades can be executed. So, smart money often aims to activate stop-loss orders already set by retail traders, using them to fill their own positions. It's widely believed that smart money may manipulate market conditions to paint a false picture, leading retail traders to think they've correctly analyzed price action. This can create a trap, where retail traders believe they're aligned with the trend, only for the price to move directly toward their stop-loss levels. Once those stops are triggered, the market typically resumes its original direction. To survive, and more importantly, to grow as a consistently profitable trader, you must learn how to recognize liquidity zones on the chart. These are areas where large volumes of orders sit and can reveal critical insights into how the market moves, helping you avoid major drawdowns. Liquidity can generally be broken into two main categories: static liquidity and dynamic liquidity. Let's break each one down briefly, starting with dynamic liquidity. Refers to the elements that influence how the market shifts and flows. Put simply, it reflects the forces that fuel price movements. To get a clearer grasp on this, imagine a rally wave in market structure, made up of a high and a low. These highs and lows signify what we call external liquidity. In essence, external liquidity corresponds to the peaks and valleys within a rally wave. Now, consider the fair value gaps that lie between those highs and lows. These are identified as internal liquidity. Price behavior in the market constantly navigates between these two types, internal and external liquidity. Think of it as a cycle in motion. Price is continuously transitioning either from internal to external liquidity, or from external back to internal liquidity. Take a look at this schematic illustration. It displays a rally wave progressing upward, clearing out the external liquidity positioned above the prior high. Following that, the price pulls back toward internal liquidity, shown here by the fair value gap. To address the imbalance left behind by internal liquidity, price then shifts back into an external phase. In this case, it moves from the fair value gap to external liquidity by taking out the liquidity sitting above that high. Once the external liquidity is cleared, price seeks equilibrium again by moving toward internal liquidity zones. This shift causes price to decline and fill the latest fair value gaps. Now let's shift focus to static liquidity, but before we dive in further, some of you have been wondering, where can we access reliable sources for financial news and fundamental analysis? The static liquidity refers to the specific zones in the market where large pool of money is resting, such as stop losses, buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple: the market requires liquidity for momentum. When price doesn't clear out liquidity before reaching a major level, it typically treats that area as fuel for its next momentum move. Static liquidity can be spotted in multiple places on a chart, such as beneath equal lows or above equal highs, above swing highs and below swing lows, around dynamic trend lines and price channels, within order blocks, above or below key support and resistance levels, within Fibonacci retracement zones, and near the body or wick of daily candlesticks. Understanding static liquidity levels gives you deep insights into how they shape price direction. Overlooking these zones can result in significant losses. Certain patterns and areas carry greater weight because they're commonly recognized by a large number of traders. This draws in more stop losses and pending orders, making it more likely that price will gravitate toward those zones to absorb liquidity. Now let's turn our attention to practical liquidity patterns and situations that have a higher probability of moving price compared to other zones. Spotting these areas on your chart adds a layer of precision to your trade setups, ultimately increasing your chances of achieving consistent wins. The first practical liquidity pattern we should consistently seek in the market is characterized by equal lows and equal highs. As the term suggests, when the price establishes internal lows at the same level, we identify it as an equal low. Similarly, when the price forms internal highs at the same level, it's recognized as an equal high. Equal lows and equal highs fall into two distinct categories: double bottom or double top and triple bottom or triple top patterns. Now let's delve into the specifics of each pattern and explore the psychology behind their formation within the market. Let's begin with the bullish. Let's consider this pattern. Imagine a structure where price broke bullishly, signaling a break of structure, and pushed upward. It then retraced, but failed to reach the demand zone formed by the B wave. Instead, price created an internal low. Another bullish attempt followed, but the momentum wasn't strong enough to surpass the recent major high. The market pulled back again, this time not breaking the internal low, forming what we recognize as a double bottom. During this phase, many retail traders, identifying the double bottom chart formation, began entering long trades. Their stop losses were placed just under the equal lows, creating a notable liquidity pool. As a result, price rallied upward, largely fueled by buying pressure from these long positions. But as you might already know, smart money often engineers situations like this, setting traps that trick traders into thinking they've correctly interpreted the market. To explore this kind of market manipulation, let's plot a bullish trend line by connecting recent lows. Retail traders relying on trend lines saw the pullback break below this support line. This breakout gave them the impression that the bullish momentum had ended, and that the bears had taken over. Anticipating a new downtrend, these traders entered short positions during the pullback. They placed their stop losses above the most recent internal high. The market briefly respected the trend line, causing a small bearish wave. This move enticed even more traders to open short positions, also placing their stops above that internal high. All of this created a prime buy-side liquidity pool waiting just above. Not surprisingly, price surged upward, clearing that accumulated liquidity sitting above the internal high. Now, we observe a demand zone at the extreme and a high volume of stop losses from retail traders nearby. This suggests a strong chance that the market will pull back again, sweep the liquidity under the equal lows, tap into the demand zone, and then reverse to resume its overall bullish direction. So, our game plan here is simple. Wait for price to take out the equal lows and touch the demand zone. This gives us the confluence we need to justify entering a long position. Once price sweeps the liquidity and taps into demand, we're looking at a prime entry point, because by then, smart money has already taken out retail stop losses and has no reason to go hunting for more. In short, the mission of smart money is to collect stop losses, and our goal is to step in after they're done. Let's walk through a practical example. We're observing an uptrend, and within this bullish move, the price has broken structure multiple times to the upside. In this context, two potential demand zones stand out. Both could be possible areas for the market to reverse and continue climbing. But here's the real question. Which of these zones gives us a safer, higher probability entry? As we mentioned earlier, a demand or supply zone becomes valid only when it's supported by a liquidity sweep. That means we want to see price grab liquidity either above or below the zone before treating it as a potential entry point. In this scenario, I'm not treating the first decisional order block as my entry point. Why? Because price didn't sweep any significant liquidity before reacting to that level. Instead, it acted more like an inducement zone, tempting traders to enter early and creating a liquidity pool right below it. We can also see a noticeable pool of liquidity sitting under the equal lows and this inducement zone, likely consisting of stop losses and pending buy orders. This setup tells us that smart money might drive the market lower to trigger those stops before reversing. By prioritizing zones with clear liquidity sweep patterns, we tilt the odds in our favor. This approach helps us avoid false setups and retail traps, giving us more reliable, rule-based trades. What adds more confluence here is the buy-side liquidity pool that exists just above our ideal demand zone. This reinforces our confidence that price may reverse once it reaches that zone. Now that we've got the liquidity sweep, the inducement, and a well-defined extreme demand zone, our move is to wait patiently for price to dip, clear the equal lows and inducement zone, and finally tap into our entry area. Once it reaches that extreme demand zone, we're positioned to go long with strong confidence, because the market has already done the dirty work, triggering stops, grabbing liquidity, and setting the stage for a reversal. Now, let's talk about the triple bottom pattern. The principles we discussed for double bottoms also apply here. The only difference is that the price creates 3 equal lows instead of 2. When retail traders identify this formation, they typically go long and place their stop losses just below the equal lows. This creates a heavy liquidity pool sitting beneath those lows, waiting to be swept. Now, in a bullish market, smart money must trigger those clustered stop losses before continuing upward. Why? Because the market needs to grab liquidity to fuel the next move. Once those stops and pending orders get wiped out, the liquidity is cleared. That's our cue. Once price sweeps the triple bottom and taps into the extreme demand zone sitting below it, that's where we can start considering a high probability long setup, because now the market has no more stop losses to hunt in that zone. Green circle equal highs, double tops and triple tops. Now let's flip it and talk about equal highs, which typically show up as double or triple tops. Let's look at a double top pattern first. The price forms 2 equal highs right near an unmitigated supply zone, right after breaking structure to the downside. This signals that sellers are in control, but here's where it gets interesting. Retail traders enter short positions at these highs, and place their stop losses just above them, creating yet another liquidity pool. Smart money, they see this. They push the price back up, clear out the retail stop losses, tap the supply zone, and then send the price back down in the dominant bearish direction. The same logic applies to triple tops. Multiple stop losses are sitting above the highs, and once price sweeps them, it becomes highly probable that we'll see a reversal from the upper supply zone. The key idea here is simple. Smart money hunts liquidity. Once that liquidity is taken, the market often reverses, and that's our entry. If price doesn't clear that liquidity and just taps the zone, that zone likely becomes the liquidity itself, and the market keeps pushing through. Bar graph trendline liquidity, bullish scenario. Now let's get into trendline liquidity, starting with the bullish setup. Picture this: price makes a bullish break of structure, but instead of aggressively moving higher, it starts climbing slowly, forming tiny break of structures and creating higher highs and higher lows in a tight range. What happens next? A trend line starts to form along these small structures. Retail traders, they draw this line, buy every time price hits it, and place their stop losses just below. What does that mean for us? It means there's a massive liquidity pool right under the trend line. Smart money is likely to sweep that liquidity, fill any inefficiencies, and then tap into a key demand zone, ideally the extreme one. After this sweep, that's when we look to go long, because retail liquidity is gone, inefficiencies are filled, and price is ready to reverse. Down triangle bearish trend line, same concept, flipped. Now let's flip the scenario to a bearish market. Here, we see a bearish break of structure, with an unmitigated supply zone sitting above. Price then starts forming small, choppy break of structures downward, and a new trend line forms along the lower highs and lows. Again, retail traders sell at the trend line, placing their stop losses just above it. This leads to a liquidity pool right above the trend line, which smart money loves to exploit. So what happens? Price runs up, sweeps the stops above the trend line, fills inefficiencies, taps the supply zone, and then reverses downward, in line with the bearish trend. That's your short setup right there. Wait for liquidity to be cleared, then strike from the unmitigated supply zone. Checkmark final thoughts. So traders, always remember, liquidity sweeps equals opportunities. Don't enter blindly on patterns like double tops, triple bottoms, or trend lines. Wait for confirmation. Let smart money do its thing first. Thanks for tuning in. If you found this breakdown helpful, make sure to like, subscribe, and hit the bell icon for more advanced trading content. Drop your questions or topics you'd like us to cover in the comments. We're here to help you level up your trading game. See you in the next one. Upward trend speech balloon.